Well, hello, folks. Some of you very well might know me. For the rest of you who don't, who either stumbled across this video through an internet search or someone shared it with you, I'm just going to introduce myself briefly. My name's Jason Potts. I'm a CPA. I operate out of Maceo, Kentucky. Most people in the world don't know where Maceo is, so Maceo is outside of Owensboro, Kentucky. A lot of people in the world don't know where that is. So if you've ever heard of Louisville, Kentucky, or as the out-of-staters call it, Louisville, that's just not right. But if you've ever heard of Louisville, Kentucky, I'm about 2 hours west of Louisville. So, like I said, I'm a CPA. I've built a practice that I've had for a couple decades, and done a lot of different things in this practice, but in this career. But the biggest thing I've done, the best way to summarize it, is I take complex financial concepts and calculations, and I try to turn it into something that an ordinary person can understand. I incorporate a lot of financial education in my practice, trying to help people understand their financial situation better so that they can make better decisions. And as part of that education, some of my clients over the years have suggested that I put together some videos for a wider distribution, things that can be shared to other folks that will hopefully help other people understand better what they're doing in their financial lives and how to make better decisions in their financial lives. So I thought I'd give that a try. So our first topic that I thought I would tackle is debt. So let's have a little bit of discussion about debt, and let me switch over to a new screen here. So if you go to the Bible, I'm a Christian, my family's a Christian, we're all Christians, and so we try to take a lot of inspiration from the Bible to hear what God's Word says about any particular topic, including financial topics. There's a lot of financial advice in the Bible if you just read it. So the biggest verse that you hear everybody quote about debt, about loans, is Proverbs 22, verse 7. And I am not at all a preacher, but depending on which translation of the Bible you look at, the message of Proverbs 22:7 is the same. The rich rule over the poor, and the borrower is a slave to the lender. And again, that varies a little bit depending on which translation you use, but the message is the same no matter what. So what's that mean? So if you take out a loan, you literally are, you're not literally a slave, but you literally are beholden to that lender. You have said, I'm going to pay you X dollars a month over X number of years. Until that loan is paid off, you are beholden to that lender. And it's just as simple as that. You don't have flexibility in your financial life if you have a payment or a series of payments due to someone else. They expect you to make those payments. In fact, you've signed a contract in almost all cases that say you will do that. And so it's not slavery in the sense that we think of that happened in the 1800s. It is slavery in the sense that you are beholden to that lender to make those payments that you have agreed to, that you're contracted to make. Let me go back to my script here so I don't lose my place. So going back to our internet, another thing I want to pull up. Albert Einstein, considered a relatively intelligent man by most folks. He coined a phrase, compound interest is the eighth wonder of the world. And I can't argue with that. And he also expanded on that by saying that he who understands it, he who understands compound interest, earns it. He who doesn't understand it, pays it. Well, if you have a bank account, a savings account, you are earning interest. You are earning compound interest. If you have a loan, if you have debt, you are paying compound interest. And Albert Einstein just flat out says that if you don't understand this eighth wonder of the world, that you pay it. And I just see that over and over and over in my clients, other folks that I've helped deal with financial situations in their life. People just don't understand debt. And I've seen just a lot of really good people struggle with it. And none of what I'm going to say today, none of what I say to my clients in my attempt to educate them better on financial topics, none of what I'm going to say to you today, none of this is a value judgment. You're not a bad person if you take out a loan at all. But what you're doing is you're inducing a lot of unnecessary stress into your life by taking out a loan. I've just seen a lot of really good people struggle with debt, and not succeed in their life, their financial life, the way that they would have had they not incurred this loan. A lot of my clients have just really succeeded beyond their wildest dreams financially. A lot of my clients struggle, and that's true not just of my clients, but of folks out in the world who I don't know. And a big difference in between the folks that I see really succeed and the ones that I see really struggle is debt and their management of debt and their avoidance or their acceptance of debt into their life. And so, part of that goes back to just a fundamental misunderstanding or lack of understanding of how debt works, what it actually costs you when you sign on that bottom line and agree to take on a loan. And so this video is going to attempt to explain just the basic concepts around debt, using simple terms and then using a recent example from my life. So let me switch over to a different view here. And so everybody that knows me gives me a hard time because I do everything in Excel. I designed this house in Excel. To quote a Excel nerd friend of mine, I dream in Excel. Yeah, if you're going to watch a video that I've put together, odds are pretty good that it's going to have an Excel spreadsheet in it. If you ever see a video with me without an Excel spreadsheet, call 911 because I've probably been kidnapped. So the first thing in this spreadsheet, a couple weeks ago, I put together I say me, it wasn't me. I actually don't have a Facebook account. So if you search for Jason Potts CPA on Facebook, you're not going to find him, not going to find me. You might find Toby Potts. Complete different video, complete different subject outside the scope of this video. I was banned from Facebook about 5 years ago now, 2020. A lot of folks that expressed political opinions not consistent, I guess, with Facebook's administration's political opinions were banned for life from Facebook. So again, whole different subject for a different day. But I don't have a Facebook account. However, my dog Toby Potts, cute little Jack Russell Terrier, he has a Facebook account and he posts all kinds of stuff. And so if you look at this this Facebook post, Toby, my little buddy, posted, "There are numerous systems in place designed to keep you poor." That's the bad news. The good news, you can choose not to participate in them. It generated a lot of discussion among Toby's friends. 27 or 29 people, it looks like, liked it. I covered up names to protect the innocent. Had 17 comments. So pretty good amount of discussion. Obviously, financial things affect everyone's lives, and a lot of folks had things they wanted to talk about on that. Now, the backstory. So what prompted this post for me on September 24th at 1:26 p.m.? I said me, of course I meant Toby. What prompted this post for Toby to make? Well, he and I had talked, and our HVAC had gone out that day, our air conditioning system in our house. Our house is about 21 years old, so it was due, had some folks come and look about repairing it, and they actually recommended that we not repair it, that we just replace it. And so I did a little bit of analysis and a little bit of research, and I agreed. So we decided to replace it. So we got a quote from our preferred local HVAC vendor, who, by the way, did a great job. I'm not going to mention them in this video, but they did a wonderful job, got some quotes back on different systems. And I started seeing things in these quotes about financing, about monthly payments. And so I called the young man I'd been talking to and said, "Look, my family, we don't do debt." And he said, "Oh, okay, well that changes things." And so he worked up some quotes, the same systems, but different numbers based on cash payment. You're just writing a check instead of making monthly payments. And so that prompted me to realize how widespread this concept of debt is. And talking to people over the years, they don't ask, what does this cost me? They ask, what will my monthly payment be? They don't look at the total cost of owning something, of buying something. They just look at what does it cost per month, and do I have that much room in my budget to pay this this additional monthly bill? And if they do, they just sign on the bottom line, go on. They don't really think about, how does a loan work? What does a loan cost me? And that's, again, what this video is intended to help you understand. So let me go back to my spreadsheet here. Not spreadsheet, our internet browser. So a couple of things to understand about a loan before we even look at any numbers. There are a couple different kinds of loans. A secured loan, meaning that the loan is secured by some asset. And so a classic example is if you buy a car and get a loan on it, that will be a secured loan. Meaning that if you quit making payments on that loan, like, they can come get that car. And there's some TV shows about the folks that make a career out of coming and getting cars that people have stopped paying on. That's a secured loan. A loan on a house, a mortgage, that's also a secured loan. If you stop paying on that loan, the lender can come take the house and literally kick you out of the house and sell it in order to pay what you've not paid them on the loan. Most loans, and what we're going to be talking about today, are unsecured loans, meaning that if you quit paying on the loan, that the lender cannot come get some asset, and so a secured loan, the interest rate on it is going to be lower, simply because the asset is backing up your ability or willingness to pay that loan. And so we're looking at an unsecured loan. HVAC loan, a loan on a air conditioner, they won't come get the air conditioner, and a big part of the reason that it is an unsecured loan and that they won't come get the air conditioner is because they can't come get the labor that was involved in installing it, and that's a big part of the cost of getting a new air conditioner installed in your house, like we did. And so I pulled up my handy dandy Google and just said, hey, what are rates on unsecured loans today? And so you see that Google's AI overview tells us somewhere in the 6 to 25%, although those are extremes. More what I would expect is in this 10 to 20% range. That depends on a lot of factors. It depends on the length of the loan, your credit score, which I suspect my credit score is next to nothing because we don't do debt. Your credit score is simply a measure of how readily, how faithfully you repay debt. Well, if you don't have debt, you typically have a pretty bad credit score, and that's okay. A credit score is not a sign of winning financially. A credit score is a sign of you helping somebody else win financially over and over and over. So I'm okay with mine not being all that great. So it hadn't seemed to slow me down. But if you did a loan, the average range is in the 10 to 20% range. And so according to Google. And that's about what I've seen in some of my clients, with some of my clients' documents that they bring to me. So if we go back over to our spreadsheet, we'll modify that interest rate. So these are not actual numbers, but they're approximate numbers on what the HVAC system replacement cost myself and my family, somewhere in the $10,000 range. But what we're talking about here, all the concepts, they apply no matter what the cost of the item is. I used to work with some folks who they took out loans to get a new set of tires on their vehicles instead of writing a check. And so that was in the $1,000 range. Obviously, if you buy a house, it's in the $100, $200, $300, $400, whatever range. And these calculations, these concepts, they work no matter what the numbers are. It's the same concept one way, regardless of the amounts. So for a $10,000 item, Now, one thing that I noticed on the quotes was that when I got the cash quote back versus a financed quote, the cost just right off the top was lower. And so I talked to him, and he said, yeah, we charge a fee, about a 3% fee, to just to initiate the loan, simply because it's more paperwork for them. Somebody writes a check, that's very easy for them too. So they charge about a 3% fee. And that's actually, if you have a car loan, there's all kinds of initiation fees, all kinds of loan initiation fees that you pay to the dealer, to the bank, to the lending institution, whoever it might be. And so in this case, we're going to assume it's a 3% because that's a real example using the HVAC system replacement that we just went through. So a $10,000 item, in this case HVAC, add a 3% fee, you're actually paying $10,300 up front if you take a loan. And I should have mentioned that column B, everything in column B is if you take a loan. Column C is if you do the exact same purchase, except you pay cash for it. You write a check, whatever. You don't do monthly payments. So if you take a loan, you're paying $10,300 just right up front for a $10,000 item. And if you don't pay anything up front, as we see here, this cell B5 with $0 in it, then you're financing, you're taking a loan for that entire $10,300. So I used 8%, assuming that someone's credit is really good, and based on our Google research that we looked at a second ago. I'll change that in a minute, and you can kind of see how that affects the results. 5 years, 60 months, that's about what you would want to do on a unsecured loan like this. Someone might say, hey, I want a lower monthly payment, and the lender would be happy to do a 7-year, 8-year loan, simply because they're going to make more money over the course of that. The longer you spread out a loan, the more it's going to cost you, and on the other side, the more it's going to net the lender who's loaning you the money. But I used 5 years because if you have to do debt, you want it to be as short as possible. So 8% 5-year loan on $10,300. You're going to have a $208.85 payment every month for 60 months. Again, borrower is slave to the lender. For that 60 months, you're beholden to that lender. So you've got 5 birthdays, 5 Christmases. How much stuff changes in your life in 5 years? One thing that will not change is this loan. And $208.85, if it's due on the 5th of the month, on the 6th of the month, you're going to be hearing from that lender over and over and over. And if you're too late, they're going to add fees to it, they're going to add penalties, all those things. So again, you are beholden to that lender for 60 months of your life, 5 years of your life. I can't emphasize that enough, obviously. So you multiply 208.85 by 60 months, and you come up with $12,530.81 approximately. I know there's some rounding in there, but it's about $12,530. So you've over that 5 years, 60 months, you've paid $2,230.81 of interest. So you've paid back the $10,300 of principal, the amount that you paid to the either the HVAC company or the lender to initiate the loan. That $10,300 total, but you've also added $2,200, a little bit more than $2,200 of interest to that as well. And this bottom line, this total paid as a percentage of the cost of the item, what this tells you is that item cost you 25% more just because you took a loan than if you had paid cash. If you'd paid cash, it would have been $10,000. You did not pay cash, so between the loan fee, the $300 loan fee, and the $2,200 of interest, you paid 125% more than you would have paid if you paid cash. If you increase the length of the loan, let's say you make this a 7-year loan, now your monthly payment is lower, but your interest is higher, $3,100 versus $2,200, and you've paid 34%, almost 35% more than if you'd paid cash. So let's put this back to 5. And obviously, if your credit is bad, and you paid a 15% interest rate instead of an 8% interest rate, now you've paid $4,400 of interest, and in total you've paid about 47% more than if you had just written a check to pay cash. And again, that's what this column over here is. So, before I leave the spreadsheet, I hope it helped you understand some basic concepts of how a loan works, because that's good information just to know. But what I really hope you take away from seeing this spreadsheet is, holy cow, this $10,000 purchase has turned into not $10,000. It's turned into $12,000, $13,000, $14,000, $15,000. Gosh, you get a, Google said a unsecured loan could be 20%, and if you say, oh, I can't afford $273 a month at 20%, the lender says, well, could you afford $215? Well, sure I could. That's no problem. And you, again, focusing on what does it cost me per month, you're not focusing on what does it cost me in total. And so you do a 20% loan over 8 years on a $10,000 item, and it costs you, in addition to this $300 loan fee, it also costs you $10,418 in interest. Meaning that over the life of this loan for a $10,000 item, you've paid more than twice. You've paid 207% of that $10,000 by the time you pay interest and pay that loan fee, and of course pay the $10,000 itself. I've seen people do bigger purchases than this on not of a HVAC system, but just bigger purchases than this on a credit card. Credit card debt is it's not quite payday lender level of interest rate, but it's still up in the 25% right now range, unsecured. And it takes them 7-8 years to pay it off, and so they literally have paid more than double of what the item cost if they had just written a check for it on day one. Not to mention, you've got this hanging over your head. If you lose your job, or your wife, your spouse loses their job during the course of this loan, you've just got this massive amount of risk. And so you've got this hanging over your head for, in the example I've got displayed here, for 8 years, 96 months. You could be completely childless, and when you take out this loan and think, well, everything's going to go great, within that 8 years, so many things can change. You could have medical issues come up. You could have children and have the expenses associated with children, but you still got this $216 a month due on the same day every month, just hanging over you. It is I can't describe to people how liberating it is to not have payments hanging over your head, to be able to do things in your financial life, either necessary things like if one of you or your spouse loses your job, or have kids, or take a vacation and not say, well, we can't take a vacation because we know we've got to pay this $216 next month, and if we take a vacation, we won't be able to do that. It is just so liberating to be able to do things without having this hanging over your head. So let me go back to my script here and make sure I didn't miss anything. Oh, yeah, this is important. So how do you avoid debt? I've hopefully done a pretty good job of, and again, I'm going to try to keep these videos brief. I'm not known for being brief. It's something new for me. But looking at that spreadsheet quickly, hopefully, helped you understand how debt works, and the types of loans, secured and unsecured, how it works, how the calculation works, and a big part of looking at that spreadsheet hopefully helped convince you to avoid taking out loans as much as possible. So how do you do that? Well, plan ahead. So in our example, my wife and I, we have an emergency fund. We know one of the downsides of home ownership is that stuff breaks. HVAC system, air conditioner, furnace, those things are mechanical devices. Mechanical devices fail. That's going to happen, and so we have an emergency fund set aside to account for that. When it broke, yeah, it sucked. We hated it, but we wrote a check for it. We did that, as you saw in that spreadsheet, simply because that was the most financially prudent way to do it. Taking out a loan adds cost. It's making someone else rich, not us. Save for emergencies. That's part of planning ahead. That's exactly what we did on this. Your car. A lot of young folks. I talk to a lot of young folks. Their biggest expense. Us old people, we've got these houses that are a huge expense and huge repair bills on them. Young people, even on a car, those cars aren't going to last forever. There's expensive things to fix on them, and so what I'm saying here, saving for emergencies, applies to everybody. Everybody has emergencies. As you get older, those emergencies just have more zeros on the end of them. But this applies whether you're young and don't have a lot of expenses, or whether you're older folks who have houses, kids in college, before college, whatever. You need to save for emergencies. And I guess most importantly, you've got to draw a line in the sand. You have to sit down, if you're married, with your spouse and say, my family is not, if it's just you, say, I'm not going to make myself poor and someone else richer by participating in debt. You have to, once you understand the concept of debt, once you understand the concept of how a loan works, going back to Albert Einstein's quote, once you understand compound interest, you realize that taking out a loan is not making you rich. It is not making you successful. It is doing the exact opposite for you. It is doing that exact thing for someone else. And so you have to draw that line in the sand and say, I'm not going to make my family poor and someone else richer by participating in debt. Bottom line, my family did that years ago. I can talk about this for hours. I won't. I'm looking at the time. I see that that's probably about long enough for a short video that you can share with someone and hopefully generate some discussion with someone you love. Again, that's just a really quick overview of debt. I really hope it helped you. If it did, I would ask you to consider liking, commenting, subscribing to my channel. Like this video, subscribe to my channel. I'd like to put together some more of these simple videos in the future to help folks understand simple concepts and succeed in their life. I mentioned this already. If there's somebody in your life that you love, that you think this video would help, please share it with them and make sure they see it, make sure they have the opportunity to see it, and hopefully learn from it. Once you get to be my age, a lot of your financial habits and financial patterns are set into place. If you can share this with someone who's young in your life, before they've developed habits and fallen into bad habits, and before they've developed patterns in their financial lives, as someone's getting started out, that is the ultimate time for them to learn good financial habits. And again, because of the math, the simple math that I showed you in that spreadsheet, a very good, very important financial habit for them to get into is to avoid debt and to minimize debt and to not be a slave to a lender for all of their life, and to make their family succeed, not someone else's family succeed. And so finally, if there's some other financial concept that you would like me to explain, or attempt to explain at least, in a future video, just tell me in the comments. And again, this is the purpose of my practice that I've developed all these years, is to help people understand concepts, help them succeed. So if there's something that I can explain in a future video that will help you or someone you love succeed, put it in the comments and I'll take a shot at it. So, all right, thank you all.